Hello everyone, for those who have joined from outside, I am Sumer Thakur, Head of ESL IIT Indore. Well, this time for the Keynote session, the ESL IIT Indore is collaborating with the Alumni Cell of Sydenham College of Commerce and Economics, Mumbai, to present our first keynote speaker of eSummit 2021, Sir Keki Mistry, CEO of HDFC. A bit about Sydenham College of Commerce and Economics. It's the pioneer institute of commerce education across the Asia, started over 107 years before, having a myriad of exceptionally bright alumni renowned across our country, who have made a lot of contributions to our society. Keki sir is also one of the alumni of the college. The college was recently awarded Asia's Most Trusted Brand Award as per the Consumer Survey report. Well, now, without further ado, I request Sakshi to take over and introduce our speaker, Sir Keki Mistry, and give a brief about him. Well, I guess Sakshi has some network issues. I request Priya from the Alumni Cell of Sydenham College of Commerce and Economics to kindly proceed further.
Yes, sorry for the inconvenience. I'll take over. Thank you so much, Sumer, for the lovely introduction of our college, and a very good morning to one and all present here. My name is Freya Sheikh, and I am from Sydenham Alumni Cell, and I feel blessed to have the opportunity to welcome Mr. Keki Mistry for today's keynote session, which is organized as a collaboration between ECell of IIT Indore and Sydenham Alumni Cell. Our guest of today's session is CA Keki Mistry, sir, the Vice Chairman and CEO of Housing Development Finance Corporation, also known as HDFC Ltd, and brings with him nearly 4 decades of varied work experience in the banking and financial service domain. In 1975, Sir began his career with AF Ferguson and Corporation, followed by short stints with Hindustan Unilever Limited and Indian Hotels Company Limited. Sir joined HDFC in 1981 as an assistant manager of accounts. After serving different roles, Sir was appointed as the vice chairman and CEO on 1st January 2010. He has played a critical role in the successful transformation of HDFC into India's leading financial services conglomerate by facilitating the formation of companies including HDFC Bank Limited, HDFC Asset Management Company Limited, HDFC Standard Life Insurance Company Limited, and HDFC Ergo General Insurance Company Limited. Sir's biggest achievements include being awarded the CEO of the Year under BFSI category at CNBC Awaz CEO Awards in 2019, BMA Management Man of the Year 2016 at the 37th Bombay Management Association, Best Independent Director Award 2014 by the Asian Center for Corporate Governance and Sustainability, one of the best CEO for Investor Relations, India at the Thomson Reuters Excel Awards 2012, Best Banker of the Year in 2011 by Financial Express. Sir was also honored with the CA Business Achiever of the Year award in the financial sector by the Institute of Chartered Accountants of India in 2011. Sir, we are honored to have you as the keynote speaker for today's session. Today, Sir will be sharing his insights on the current perspective on the Indian economy and housing sector. Thank you so much, Sir, for being here. So you can continue with your session.
All right, let me first of all wish all of you a very good morning. I would like to thank IIT Indore and the Sydenham Alumni Cell for inviting me to speak at the summit for 2020-2021. I will divide my talk into two parts. I will begin by giving you a sense of the way I see the economic situation, both globally and in India, followed by the current developments in the housing and the real estate sector. In one of the most unprecedented events of our lifetime, the COVID-19 pandemic unleashed a macroeconomic earthquake in its wake. The sheer scale and speed of the unfolding human tragedy was completely overwhelming. Personally, I had never imagined in my wildest dreams that a virus outbreak of such gigantic proportions could happen during my lifetime. The rumblings of the pandemic began in December 2019, or at least that is the time when we first heard of it. But like other epidemics in recent memory, it was thought that the spread would be limited and a cure would be found soon. For instance, epidemics such as SARS and the H5N1 avian influenza that occurred in the early 2000s each had an impact of just 0.1% annual GDP loss to the global economy. It is estimated that the total fatalities from both these global epidemics was just about 1,000 lives. COVID-19 is different as the transmission is faster and it transmits through carriers who don't show any symptoms. The economic costs too are extremely difficult to comprehend. Many economists are of the view that the COVID-19 crisis will impact global economy far more than the financial crisis of 2008. According to the IMF, the world economy is likely to face a cumulative loss of US dollars 12 trillion from the start of the crisis until the end of 2021. No statistical model was ever or would ever have been able to predict the sheer scale, speed, and magnitude of this crisis. IMF has stated that the COVID-19 pandemic has had a higher negative impact on both economic and day-to-day activity than anticipated. And there is still a high degree of uncertainty in making forecasts. I'm talking more of the global economy at the moment, not about India. As the dust is settling a little bit after this torrid health catastrophe that affected millions and which has threatened to leave a permanent emotional scar, we are hopefully seeing some light at the end of the tunnel. The world has never faced a downturn of this speed, scale, or severity. Yet, as a result of the vaccination drive, the worst is hopefully behind us. Also, deep recessions are usually followed by rapid recoveries. The recent spurt in the number of COVID positive cases all over India is, however, still a major cause for concern, and we need to really wait and see how that pans out. The global growth in 2020 is estimated to contract by 3.5%, which is a negative 3.5%, compared to a negative 4.4%, which was projected earlier. This clearly reflects the stronger than expected momentum that we saw in the second half of 2020. The global economy is projected to grow 5.5% in 2021. The recent approvals have raised hopes of a turnaround in the pandemic later this year. Of course, renewed waves and new variants of the virus do pose some serious concerns and challenges. The mood across the world is now more optimistic, and governments are working towards getting people back to something closer to normal. There is recognition of the need to increase office footfalls, which would help improve public confidence. As regards India, as you know, we enforced a very strict lockdown from 25th March 2020 up to the end of May 2020. The economic cost of the lockdown has been huge, with certain sectors such as airlines, hospitality, real estate, and retail being impacted the most. India's GDP grew by 4% in FY20 against the earlier estimate of 5%. The fourth quarter GDP grew by only 3.1%, which reflects the impact of the first 2 weeks of the COVID-19 lockdown. India was amongst the few major economies which imposed such a strict lockdown. India's GDP contracted by 23.9% in the first quarter. For most sectors, 2/3 of the quarter entailed a strict lockdown. It is important, however, to reiterate that India is not an outlier with its GDP contraction. In fact, in my view, the government did absolutely the right thing in imposing the lockdown at the time when they did, because that is really, to my mind, helped in a big way in curtailing the number of cases that we subsequently saw. And we've seen what's happened to the other countries, the Western countries. As the lockdown measures began to ease, India staged a recovery in the second quarter of the current financial year, which is FY21, suggesting that the resumption of economic activity has been gathering pace. India's GDP is expected to contract by 7% in FY21 from an earlier estimate of 9.5%. But again, if I can just go back a little into what happened in April, May, or in May, June, when the lockdown was at its peak, most of the analysts, most of the economists were talking of a negative GDP growth of double digit. And people were talking of numbers which were ranging from 10% to 12%. So I think it's a huge credit to the government, to our regulators, and to the country that we have been able to ensure that the contraction in GDP is only about 7.7%. Effective management of the COVID-19 spread, especially during the festive season and the onset of the winter season, was one of the biggest contributing factors that led to a much faster than expected recovery. As a result, India's GDP grew by 0.4% in Q3 FY21, which has shown that India's economy has returned to the pre-pandemic period of positive growth rates. It is estimated that India's GDP will rebound to a strong growth of between 10.5 to 11% in this quarter, which is the quarter starting today, starting April 2021. The vaccine approvals and the subsequent process of inoculation have raised hopes of a turnaround in the pandemic later this year. Of course, renewed waves of infection in India do pose some serious concerns. As regards corporate India, the overall performance during the first quarter of 2020 was obviously weak. This is obviously what we would have expected. The weak performance was led by manufacturing companies, while services sector companies, especially those in the IT sector, continued to remain in positive terrain. On a positive note, several businesses began to show improvement on a month-to-month basis as the lockdown measures began to ease. Apart from abundant global liquidity and the development of the COVID-19 vaccine, optimism around the December 20 quarter corporate earning results has led to Indian equities hitting an all-time high over the last couple of months. These encouraging trends show that the worst seems to be behind us and that the recovery is significantly faster than what we had earlier anticipated. Some sectors such as e-commerce and agriculture did perform well during the lockdown. Pent-up demand is beginning to unfurl and should continue to do so in the coming months. In fact, small towns are outpacing metros in consumption. These towns are witnessing good demand for electronic cars, two-wheelers, apparel, and food. Despite the pandemic throwing a wrench into India's economic growth last year, the finance minister clearly indicated in the union budget speech that India is on course for a US $5 trillion economy. I do strongly believe that it is an achievable target, and if one observes the progress of the Indian economy, it has been remarkable. It took India 60 years post-independence to become a $1 trillion economy in 2007. It took another 7 years to become a $2 trillion economy in 2015. If not for the pandemic, India would have easily been a $3 trillion economy by 2020. India is now likely to become a $3 trillion economy before the end of financial year 2022. So the question is not whether India will become a $5 trillion economy or not, but the question really is how soon will that happen? There is no other economy in the world that currently has the capacity to absorb the scale of investments that India needs or has the growth potential that India offers. The RBI, on its part, the Reserve Bank of India, as you know, has been proactive and has introduced a host of measures, including reducing the repo rate twice since March by 115 basis points to 4%. The previous instance where the repo rate was reduced to sub 5% was April 2009, during the peak of the global financial crisis. Between February 2020 and early December 2020, the central bank infused an estimated rupees 12.9 trillion or 6.3% of the nominal GDP so that corporates had enough liquidity and better access to working capital. To augment liquidity in the system, the RBI reduced the reverse repo rate, cut the cash reserve ratio, conducted targeted long-term repo operations, and introduced refinancing facilities. To ease the financial stress due to the intense disruptions of COVID-19, the RBI had permitted banks and financial institutions to allow a moratorium on payment of installments for all term loans outstanding on March 1st, 2020. The extension of the moratorium was allowed up to August 31st, 2020. Now that the moratorium is over almost 8 months ago, banks and financial institutions are closely monitoring the repayment of money from borrowers. RBI has also approved a one-time restructuring plan for eligible corporate exposures as well as for personal loans. There is recognition on the part of the authorities that some sectors have suffered considerably more pain than others and would therefore merit a different treatment to facilitate their recovery. To explain further, a loan restructuring allows lenders to reschedule loan repayments or extend the loan tenor depending on the current repayment ability of the borrower. There were some concerns that the stress in the balance sheet of banks could intensify as the effects of the moratorium and the restructuring recede. Positively, banks have entered the health crisis with stronger capital buffers than during the global financial crisis. Also, very positively, the results of banks for the December 2020 quarter reveal a significantly lower level of stress than what was expected by the analysts, the media, and some of the economists. There were also some concerns raised on the higher inflation rate, which was well above 6% since June 2020. However, there was consensus that the high rate of inflation was caused by supply disruptions, including labor shortages and high transportation costs. Encouragingly, inflation eased to 5.03% in February 2021, which is within the RBI's comfort range. However, oil prices have inched up to $64 per barrel from $30-35 per barrel during the height of the pandemic due to positive developments on the vaccine front, increased economic activity, and extension of production cuts by OPEC. This has resulted in further increases in domestic fuel prices and could, over a period of time, put some pressure on inflation. As regards to fiscal deficit, I was very happy to note that during the peak of the pandemic, the government did not become overzealous in its stimulus package. The finance ministry had to keep one eye on the fisc, which really was the right thing to do. In the recent budget, the government kept the fiscal deficit at 9.5% of the GDP for FY21 and at 6.8% of the GDP for FY22, which to my mind is a very manageable target when taken in the context of the health catastrophe that affected all of us. In my view, it is better to keep the fiscal deficit higher now and bring it down progressively to 4.5% of the GDP by 2026 to achieve fiscal consolidation. Under these exceptional circumstances, investors and the market will not view the higher fiscal deficit in any way as a negative. Between the disinvestment commitment and an expected higher growth in the coming period, the government should be able to raise the resources to meet the fiscal deficit target. I do believe that India's pace of reforms will continue. Sound regulatory policies and implementing structural reforms will help India attain a very swift economic recovery. Some of the positive signs that I see on the economy are as follows. Firstly, if you look at our foreign exchange reserves, they are at a very comfortable level of $582 billion as of March 2021. This covers 14 months of imports. The main reason has been the rise in foreign portfolio investments and FDI inflows. India is now the fourth largest holder of reserves after China, Japan, and Switzerland. Secondly, our current account deficit is steadily falling over the years. During FY 2020, the current account deficit stood at just 0.9%. In fact, India achieved a current account surplus for 3 consecutive quarters, namely 0.1% of the GDP in quarter 4 of FY20, 3.8% of the GDP in quarter 1 of FY21, and 2.4% of the GDP in quarter 2 of FY21. However, the trajectory of the oil prices needs to be watched as India imports 80% of its oil requirements. Thirdly, the rupee has performed very well during this period and has depreciated only by 2% against the US dollar since January 2020. In this regard, India is better off than other emerging countries such as Brazil, Russia, Turkey, and South Africa, whose currencies depreciated upwards of 20% against the dollar. Fourthly, the risk averseness in the system appears to be subsiding. After a 5-month stretch of a sub 6% growth in bank credit, the pace of growth in bank credit has increased to about 6.5%. I would say fifth is that from April 20 to December 2020, India received FDI of US dollars 51 billion, which is a 40% growth over the previous year. We are now the world's ninth largest recipient of FDI inflows. Over the past few years, India has progressed significantly on the World Bank's ease of doing business. In 2019, for example, we recorded a jump of 14 positions to be ranked 63rd. Our monsoons for 2020 was above normal. The Kharif crop cycle was not affected by the crisis. Further, it is estimated that rural employment has come down significantly thanks to Narega and Kharif sowing. The RBI said that the outlook for agriculture is robust. The winter crop sowing has also seen a healthy year-on-year growth of 2.9%. COVID-19 has provided a huge opportunity for India to establish itself as a manufacturing base for Western countries. India also has an immense opportunity in sectors like IT, back office, healthcare, fintech, and e-commerce. Also, very important to note that India is rapidly digitizing. Our digital economy is expected to be US dollars 1 trillion in 2025, when the total economy touches about 5 trillion US dollars. That is 1/5 of the Indian economy will be digital. India has almost 700 million internet users, and this has immense potential to grow manifold. We are the second fastest digital economy after China. The high frequency data, be it e-toll collections, e-way bills, digital transactions, two-wheelers, passenger vehicles, tractors, electricity, fuel, freight, all these have shown sequential improving trends. In fact, persistent improvement in e-way bills and highway toll collections have risen above pre-COVID levels. GST collections have continued to sustain momentum and were at 1.13 lakh crores in February 2021, showing a year-on-year growth of 7%. Financial penetration in India is extremely low. This implies huge potential for growth in the financial sector. The mortgage to GDP ratio in India, for example, is only 10%. In China, it is 26%. In the US, it is 53%. And in some of the European countries, it's as high as 80 and 90%. India, by comparison, is only 10%. Other indicators include insurance penetration in India, which stands at 3.7% of GDP. If you compare ourselves with Malaysia, Thailand, China, all these countries have ratios closer to 5% of GDP. Our mutual fund penetration is 15% of GDP. And if you compare that with the Western countries, you'd be surprised to find that in the US, it is 114%. And in the UK, it is 73%. We in India is only, in our case in India, it is only 15%. So obviously, the potential to grow in all these sectors, be it insurance, be it mortgage, be it credit cards, be it mutual funds, the potential to grow is enormous. Also, very importantly, we have favorable demographics. India accounts for 17% of the world's population, or 1 out of every 6 person in the world is an Indian. 66% of our population is under the age of 35 years. India's middle class is estimated to rise from 250 million individuals currently to about 800 million by 2030. Ours is a domestic consumption-based economy. Private consumptions form 60% of economy. So we are not therefore dependent so much on what happens in the Western world and what the demand plays out in the Western world. We can control our own destiny. We are also poised to become the third largest consumer market behind US and China. Consumer spending in India is expected to grow from US dollars 1.5 trillion at present to nearly US dollars 6 trillion by 2030. Lastly, there is no dearth of entrepreneurship in the country. We have the third largest ecosystem for startups behind China and the US. So this was the first part of my talk when I talked about the Indian economy. Let me now quickly touch upon the housing sector. World over, the housing sector is widely considered as a significant engine for the growth and development of an economy. In the US, for example, housing starts are closely monitored and are often considered as a barometer to gauge the state of the economy. In several Western countries, one of the effects of the pandemic has been a structural increase in housing demand. For many analysts, the housing market recovery has exceeded all expectations, and many have substantially upgraded their 2021 house price forecasts. Housing, together with food and clothing, are traditionally thought of as basic needs. Housing is an important component of both investments as well as the economy as a whole. In many countries, home ownership forms the largest component of household wealth. Many households tend to hold wealth in the form of their home rather than in financial assets. Hence, a well-functioning housing sector is critical for the overall health of the economy. If we look at the growth of housing finance in India over the last 2 decades and compare it with India's economic rise, the success of both can be attributed to the structural changes that are taking place in India. Growing nuclear families and increasing mobility of the workforce has transformed the attitude of the current generation, as younger people are more willing to borrow money and also want to buy their own homes. Housing encompasses financial inclusion and provides stability and security to a household. Housing is also a good indicator of a country's sustainability. Due to the ongoing reforms and incentives, the housing and real estate sector has become structurally stronger over the years. The government has recognized the critical role that housing and real estate plays in the Indian economy. Last year, RBI introduced several measures to alleviate the stress of the housing and real estate sector, such as liquidity infusion for housing finance companies, partial guarantee schemes, refinancing facilities, rationalizing risk weights for individual housing loans, and so on and so forth. Importantly, the real estate sector was one of the 26 sectors that was approved by RBI for a one-time restructuring plan. In recent times, the housing and real estate sector was initially affected by the unprecedented crisis caused by the pandemic. During the first quarter of 2021, home buyers adopted a wait and watch attitude. Positively, over the last 6 months or more, we have clearly seen a sharp increase in the demand for residential housing on a pan-India basis. The latest economic survey of 2021 has stated, and I quote, "The housing market, which is a key forward linkage sector for steel consumption, saw gradual resurgence from Q1 2020-21 drop. At HDFC itself, our individual loan disbursements have surpassed earlier expectations of a much more gradual recovery. We continue to see demand pick up much faster than anticipated earlier. Our year-to-year retail disbursements not only continue to improve month-on-month since the lockdown, but more importantly, from September onwards, there has been a consistent growth in disbursements compared to the same month in the previous year. And you must remember that the previous year was unimpacted by COVID, whereas this year has been impacted by COVID. So, but despite that, on a month-to-month basis compared to the previous year, we have been seeing a growth, and the whole industry has been seeing a growth. Improved affordability, together with the lowest ever interest rates on housing loans, coupled with stable to lower property prices, has made it very attractive for home buyers to buy a property now. Government support and rising incomes have contributed to improved affordability. As per our estimate, this is arguably the best period in terms of affordability in over 2.5 decades. Around 25 years ago, it would have taken about 22 times a person's annual income to be able to afford a modest-sized home in most of the big cities in India. Today, this affordability ratio has improved to less than 3.5 times the annual income. In addition, fiscal incentives by the government have also played a key role in encouraging people to borrow money to buy a house. I am optimistic about the future of the housing sector, as demand for housing remains insatiable in a country like India, which has a huge housing shortage. There is a tremendous potential for growth as the penetration level of mortgages in India is extremely low compared to other countries. I mentioned earlier that the mortgage to GDP ratio in India is only 10% compared to China at 26% or US as 53% or some of the European countries in the 80s or 90% range. Housing is also a basic necessity and not a luxury. Most middle income people who take loans to buy a house are genuine end users and intend to stay in the house that they purchase. Data over the years has clearly shown that housing loans have much lower defaults and consequently a better credit risk profile compared to other kinds of personal loans. Also, demand for housing has proved to be relatively inelastic, even in a higher interest rate environment or during a temporary slowdown in the economy. The structural demand for housing in India will always be strong due to factors such as improved affordability, government's trust on affordable housing, favorable demographics, increasing urbanization, and rising aspiration of our people. It's, I think, important to understand that two-thirds of India's population is below 35 years of age. And unlike the West, in India, people do not go to buy a house when they're in the early or mid-20s. The average age of a first-time home buyer in India is much later. It's nearly 38 or 39 years. And with two-thirds of the population being below 35 years of age, what that really means is that two-thirds of the population has not even contemplated or thought of buying a house. But over the next 5, 10, 15, 20 years, all these younger people will get to an age where they will necessarily have to buy a house. So therefore, in my view, there will be a structural long-term demand for housing and therefore housing finance in India. In my opinion, this is one of the best times to buy a house. Interest rates are at an all-time low, and it is extremely unlikely, in my view, for rates to go down further in any significant manner. Also, certain states have provided time-bound relief. For example, as you know, Maharashtra had lowered the stamp duty rate to 2% for properties registered till December 2020 and 3% for properties registered till March 31st, till yesterday. Coupled with interest rates being at an all-time low and with this reduction in stamp duty, Mumbai recorded historic registration of house sales in the months of November and December 2020. As a result, the state government's treasury collection from registrations increased significantly, inferring that strong home sales had more than compensated for the lower stamp duty. The government has recognized the critical role that housing and real estate plays in the economy. The housing and real estate sector is an important component of the Indian economy, contributing as much as 6.4% of the GDP. It is also the second largest employer in India after with nearly 300 industries, generation of employment and income opportunities. The real estate sector catalyzes and stimulates economic growth. If India is to reach its full potential, job creation is important. As the real estate sector creates jobs directly and indirectly, there is a need to support the sector. According to India's economic survey of 2017-18, nearly 90%, 90, of the workforce employed in the real estate sector are engaged in the construction of buildings. The survey also shows that over 80% of the employment in the real estate and construction sector constitutes minimally skilled workers. It is important to note that
I guess we are facing some network issues. Sorry for the inconvenience, I'll look into it.
Sorry, I think it got muted for some reason.
Yes, sir, we can hear you.
Should I continue?
Yes,
Yes.
I think it got muted for some reason, and the video also. You can.
Yes, sir,
So
you
I'll
are
just continue
audible.
from where it was.
Sure,
Yes,
sir.
Yeah. The government's trust on housing is a recognition that a rapidly growing country like India, with a large young population, needs more homes at affordable price points, which would enable more households to become homeowners. Another trend we are witnessing is the increasing focus on rental housing. Various attempts have been made to we are beginning to see hope and optimism with the approval of several vaccines globally. So I'm just trying to conclude now. The pace of the distribution of the vaccine over the coming months will be crucial and will be watched closely by all. However, one of the biggest risk factors is the sudden spike that we have witnessed in recent days in the number of COVID cases. Hopefully, the spike will be controlled. Over the past decade, India has endured several crises, such as the global financial crisis of 2008-2009, the US Fed's taper tantrum in 2013, and the ILFS default in late 2018. The common thread was that it created an atmosphere of risk aversion, but regulatory measures and the inherent strength of the Indian economy with its strong fundamentals led to recovery. India has proved to be a very resilient economy. In a post-COVID-19 world, India will be able to climb back up the growth ladder. The main reason for my optimism is that India is a strong domestic consumption-based economy, and penetration levels are so low in India that the scope to grow remains intense. On the same lines, I have a very positive outlook on the housing and real estate sector in India. This sector has endured several unprecedented events over the past few years. Despite bracing such events, the housing and the real estate sector has usually come out stronger than before. In conclusion, let me say that when this is all over, we will look back and not be able to believe that such a scenario happened. It is often said that India performs best in a crisis. The pandemic may just become a catalyst to bring in further reforms and to ensure India's sustained long-term growth. Thank you very much.
Well, thank you, sir, for your guidance. And now we would be having the question answer session. So all the people participants can send their questions using the chat to us, and we would be presenting those questions over here. So, sir, for the first question, we would like to ask that since the COVID times, like there has been we like social distancing norms have been regulated and all. So, what has the way the technology helped in banking and housing sector during these times? So, in a general perspective.
I think absolutely. I think the biggest boon of, if you ask me if you can call it a boon of COVID-19, was that it induced every company, irrespective of which sector it was, and more so in the financial sector, to significantly invest, to increase their investment in technology, in digitization, and so on and so forth. So, for example, at HDFC, we now have end-to-end solutions. So a customer can do everything online, and we are the first in India to do that. But that, as far as housing goes, but similarly in every other sector that we would see, there has been a huge investment that has been made in technology. Early part of the year, as you are aware, there was a lockdown. People had to work from home, and with everyone working from home, it was obviously extremely critical that the technology that was available would support that kind of growth.
Well, so for the next question, as we have observed, like a lot of youngsters are now looking into the options of having rental homes and putting the money that they would be spending on housing sector into some instrument, financial instrument like stocks or anything. As we have generally observed that in a short-term scale, they offer like more returns compared to the housing sector. So, what's your take on this general trend that's been there?
Well, my view is you have to have a combination of both. In my view, you need a combination of real assets and financial assets. You cannot have only real assets, which is real estate, and you cannot have only financial assets. So you have to look at a combination of both. What housing does, or what home ownership does, it makes you much more confident of facing the future, because you have a house, and the house price really never really depreciates. Historically, if you see, yes, there could be temporary ups and downs, but historically, if you see, house prices over a period of time will always appreciate, though it might sometimes appreciate at a pace which is lower than the pace at which financial markets appreciate. But financial markets bring a lot of volatility with them. Housing will not bring that volatility. I know of so many people in the big cities. You take Mumbai as an example. I know so many people in Mumbai who would have worked all their life in Mumbai, earned money during their lifetime, invested money into buying their own home, and then when they retire, they would sell their house, earn a decent sum of money, use that money to buy a house in another town, in a smaller town where house prices are lower, and use the remaining amount of capital that they get to put in financial deposits or financial instruments, and then sustain their long-term livelihood. So I think it's a combination of both. Rental housing is important for people who have jobs which require them to move from one city to another city, because in every city you cannot obviously go and buy a house. You need a rental market for that. But for home ownership for a family, I think it is extremely critical, extremely important.
So like we had the subprime crisis in 2008 in US. So what do you and there were major drop in real estate pricing and all. So the people started fearing this market as well. So do you think the fear still exists, or like has it gone up or
I
gone
think
out?
the I think the fear seems to have gone away. See, house prices will never depreciate below a certain level. If you see in the peak of the financial crisis, well, not the financial crisis, the uh, uh, pandemic when it set in, you saw how sharply stock prices came down very, very sharply. If you see from February 2020 uh, the share prices and March 2020 share prices, you saw a big dip in prices. Real estate prices probably would not have gone down even remotely as much as share prices would have gone down. But then stock markets revived significantly post that. So stock markets or financial assets give you greater volatility, whereas housing will give you greater stability. So it's a
Well, sir,
combination of both housing and
as we saw.
yeah, sorry. And my personal view is that what COVID has done, it has made it more important, or made everyone realize that it is extremely important to have a house, to have a larger house, because in a situation where both husband and wife are working from home, you need bigger homes, you need separate rooms so that there is some degree of privacy. And that is reflected, therefore, in the housing boom that you have seen all over the world. It's not just in India. We've seen a housing boom in India also. When I say boom, I mean demand. I don't mean a rise in prices. I mean just sheer demand. But you've not only seen this in India, you've seen this in every country in the world.
Well, sir, like, what's your take on the government packages and all the policies that they have, which are affecting the housing sector and the housing players like HDFC and all?
I think, first of all, the government has done a phenomenal job, and one must compliment the government for what all they've done for the housing sector over the last 5, 6, 7 odd years. There is so much that has been done to create more stability, to create more faith, to create more belief in the housing sector. For example, you had the Real Estate Regulatory Act that came in, which sort of gave a lot of protection to customers and to tenants. So a lot has been done by the by the government. There are fiscal benefits on housing loans. The interest you pay on a housing loan is tax deductible. The principal repayment of a housing loan is also tax deductible, obviously up to certain limits. Then I refer to the CLSS scheme of the government, which is a credit linked subsidy scheme, where the government subsidizes part of the interest that is payable by a customer on a housing loan for certain category of customers who meet certain conditions. So there is a tremendous lot that has been done by the government to encourage housing. And I think the government also recognizes the fact that by giving a boost to the housing sector, effectively you'll be giving a boost to all the core sectors in the economy, like cement, steel, paint, power, which are really the core sectors in an economy. All of these will get a boost when housing gets a boost. And housing creates so many jobs, both directly and indirectly. Directly in the form of construction workers, masons, carpenters, plumbers, engineers, and so on and so forth. And indirectly in the form of jobs created in industries like the ones I talked about, cement, steel, paint, power, and so on and so forth. So the government's done a phenomenal amount for the housing sector and has facilitated and helped it grow so much and improve home ownership in the country.
So recently we have like come across that the government is initiating the privatization of various PSUs or these organizations, and the bringing IP of other organizations like LIC. So how would this impact the economy of India, and what could be the pros and cons of such a privatization if it
Well, I
happens?
think this incentive is an important thing. As the Prime Minister has said that the government should really not be actively involved in business. So I think the privatization is a very, very good idea. Privatizing LIC would be a huge thing. People are all sorts of people are contemplating what the market capitalization of LIC would be, but obviously, whatever be the final number, it will be huge, it will be massive. So it will create more opportunities for investors, both domestic and international, to take part in the insurance sector in India, which is a very fledgling sector. I gave you some numbers in my talk of how low the penetration level of insurance is, and therefore how much scope there is for insurance to grow, both in terms of life insurance and in terms of general insurance.
Well,
Also,
sir,
also you must remember ours is a young country. Two-thirds of our population is below 35 years of age. But over a period of the next 3, 5, 10 years, many of these younger people will get to an age where they will necessarily prefer to have some kind of an insurance cover. And therefore, the scope for insurance to grow in India will be massive.
Sir, apart from these sectors, the core sectors, we have recently observed the boom in cryptocurrencies. So what's your take on the same? Like, we have seen a massive rise in it, and now,
Well,
like,
there are
a lot of
well,
youngsters are getting into it.
yeah, there are differing views on cryptocurrencies. My personal view is it is there to stay, but there are also people who have been heavy critics of the cryptocurrency. So I think the jury's still out, but my personal view is it is there to stay.
Okay, so let's take the last question for the day. What's your view on the financial education of India currently, the education that we are having?
I think the education system in India has undergone a lot of reform in the last 5 or 6 years. Uh, and there is so much focus on education, and rightly so. If you look at, if you see in 2013, the Companies Act was amended, which made it mandatory for a company to contribute 2% of its average profit for the last 3 years towards CSR activities. And if you track these CSR spending of companies, you will see that a very significant part of the CSR spending over these years has been on education, whether it is be education of the poor, education of the middle class, improving the class of education and all. So there is a lot of focus on education. Of course, now in the last 1 year, a lot of the priority of the or a lot of the CSR money has gone into this health crisis and the pandemic. But this is a temporary phenomenon. The focus on education or the focus on corporate spending on education will come back in a big way in the year or in the next year or two.
Well, I guess there are a lot of questions I guess coming up. So but since you have limited time, we would like to conclude the session. Thank you, sir, for the wonderful session. I believe all the participants have learned a lot from you. We are very grateful to have you taking your time out from your busy schedule to address us. On behalf of ESIL and the Sydenham Alumni Cell, I would sincerely like to thank you for having us over
My
here.
pleasure. Thank you very much, and I wish all the students and everyone who's there on your program and in your campus the very very best in the years to come. India offers tremendous opportunities to grow, and you are in the right place at the moment. You have a great future ahead of you, and all the best to all of you.
Well, thank you, sir. On behalf of the ESEL, I would also like to extend a vote of thanks to the Sydenham Alumni Cell, the principal of Sydenham Alumni College, Dr. Madhuri Kagalkar, Dr. Ritesh Singhal, Associate Professor in Economics and Professor in charge of Alumni Cell, Shri Ajit Lavani, Group Leader of Proposed Sydenham Alumni Cell, Ms. Freya Sheikh, Chairperson of Sydenham Alumni Cell, and her teammates. I thank you all for having. I'd like to thank the participants and everybody present over here, Director Sir, uh, Santosh Vishwakarma Sir, Swaminathan Sir, General Secretary Sudeep Patra, uh, for coming up and having on the session of first keynote session of E-Summit.
Thank you so much, Sumer. Thank you so much, Keki Mistry, sir. It was an honor to listen to you, and I bet 45 minutes weren't enough for us to gain all that knowledge and insights on the topic. We're really looking forward to have another session, maybe soon, with you all. Thank you so much, Sumer. And I would also like to extend my gratitude towards ECEL members. I thank the director of IIT Indore, Mr. Nilesh Kumar Jain, the head CIIER officer, Mr. Swaminathan, and the entire team of ECEL IIT Indore for organizing this insightful session. A big thank you to our wonderful audience to make this event successful. Thank you so much. Thank you so much, Mr. Keki Mistry, sir, once again.
Thank you, everyone. Thank you.
Thank you.
Thank you.